Folks, we're back with another week of earnings. We got a big day today. Several companies to talk about. Let's roll right into it, starting with Uber here. Obviously, one worth mentioning is the, you click on a button accidentally, but stock's down pretty massively. You see, again, we've seen some bad responses to earnings as of late. I mean, the past couple weeks, we're not talking about subtle moves here. We're talking about 5+% moves right off the jump. So these hedge funds, they're getting really antsy with these earnings, waiting for good numbers. Kind of shocked here. I am somewhat shocked that the response of Uber would be this. You think about Uber, and last year their business was entirely shut down, basically. Rideshare just wasn't happening. The only way that they were making money, frankly, was off of Uber Eats, and again, that's their main strategic play that was keeping them in business even. So should be very easy comps this year, all things considered. You're talking about a year in which they had zero rideshare revenue, or the quarter in which they didn't have any. And it's still relatively weak from there. Should be easy to beat, but what can happen? You look year to date, the stock's down already 18.2% prior to today's after-hours movement, but still up 25% in the last year, which is seemingly crazy when the entire business was shut down. So let's just consider that. Let's look at these earnings, though. See why this reaction might be what it is. 6.5 now. Gosh, it's going bonkers, baby. Summer sale. Don't mind if I do. Quarter two GAAP EPS here, 58 cents. To beat by $1.11. Profitability on this company is a big shocker. My expectation is there's likely a reason for it. They must have gotten some sort of award money, something. Because this company typically is not profitable, but if they manage to pull this off, I'm pretty excited for them, frankly. So let's see what that in the press release, see what shows there. But that's a nice major beat. So I don't know. And from a revenue perspective, $3.93 billion, up 75% year over year. As I said, easy comps is a beat by $170 million. I mean, off of these numbers alone, I don't see where the downward movement's at. I really don't, unless they were. I mean, I don't know what their expectations were. Gross bookings at 21.9 compared to 20.9 consensus. A beat there. And monthly active customers at 101 million compared to 100.4 million. I mean, am I going crazy here? I don't see the negative yet. We'll take a peek here at the press release, and I'll just tell you right now, if you ever try to navigate their investor relations page, you scroll down the wheel once, and it's like you're having a headache here. I mean, like, could I just see words? Why do I need these random pictures in between that flash? Get out of here. Let me scroll down. Net income at $1.1 billion. Look at that. And adjusted EBITDA negative $509 million. So, yeah, again, there's something fishy there with that net income line. So I'm sure that they were some sort of awarded cashish to them. If the adjusted is negative still, so we'll see what that looks like. But gross bookings up 114%. Let's look at some of the financial highlights. We saw that there. Nice stuff. Mobility gross bookings at $8.6 billion. Is up 184% year over year. As I mentioned, that's the significant segment for them. But delivery still saw an 85% year over year growth, which was crazy because it was doing great numbers last year. Revenue up 35% quarter over quarter, 105% year over year. Nice to see. Mobility revenue up 90% quarter over quarter, 106% year over year. I mean, yeah. I mean, what do you expect? That's good stuff. Net income included a $272 million in stock compensation. Benefited from an unrealized gain of $1.4 billion and $471 million due to revelation. Uber's equity investment in Didi and Aurora, respectively. So, yeah, again, it's closer to this adjusted line, frankly. So, I mean, good for them. Good for them for this investment. Obviously, panned out for them. But, again, the company's operations itself still losing money quite a bit of money. That's why I don't like the company. But, again, what can you say? Mobility adjusted EBITDA was down $119 million. And that's, again, where you see that because that's a positive number. And you see the negative, where all that negative adjusted line comes from, frankly, is from the Uber Eats segment. definitely a scary thing when the delivery segment's that far negative. Delivery adjusted EBITDA negative 161 million, and again, that's a big problem for them. Frankly, it's a huge negative aspect. They used to be negative in the mobility segment too, so it's good to see they're positive there. Increased by 71 million year over year, so there's growth there. Negative 1.2% margin. Yikes. Negative 8.2 in the delivery segment, negative 1.2 in the gross bookings margins as a percentage of the gross bookings, I should say. Yeah, I mean, I don't know if I see where the negativity's at. I mean, I don't know. Again, I don't know. I think there's just a lot of strange, harsh reactions to earnings right now. I don't know if I get necessarily what the negativity standpoint looks like from a freight standpoint. Obviously, another segment of their business they don't necessarily highlight as much, but we see growth there as well. I don't know. I don't know what to tell you. I do want to say we're going to look at the balance sheet because it's something we do. See if I can find something. Let's scroll this bad boy over. What's going on here with this balance sheet? You think you can play games with me? Well, let me... okay, very much terrible web design, but that's okay. We can make it work. That's the thing. I'm pretty bright. Even though your website's designed terribly, Uber, I'll figure it out. So, we get a 6 months comparison here. Right now, sitting at $7.7 billion in total current assets compared to 9.8. Decreased pretty well all around the board. Nothing crazy there, though. Total assets in general saw a rise, 36.2 billion compared to 33.2. Growth there for sure. We like to see it. Current liabilities rose 7.6 compared to 6.8 billion, and total liabilities in general also rose at 20.5 compared to 19.48. But again, assets rose by a little bit more. You look overall in equity, second to bottom line here, it did see an increase, 14.1 compared to 12.96. So there is an increase in the last 6 months in equity for shareholders, so it's good to see that. But overall, you look at the stock, and there's a couple things that stand out to you. $78 billion market cap as is. I think it's expensive. Frankly, for the company that it is right now. We're talking about a company last year made $11 billion, which is pretty significant based off of the amount of business they lost. This year, probably around $14 to $15 billion in revenue. Let's say 15 to 16. I think is better. It's not incredibly expensive when you look at that aspect, but I just think due to the lack of profitability on this company still. And I mean, we see signs of getting better, but the delivery segment doesn't look like it's going to be profitable, and that's their main segment. It's not going to be profitable for a couple of years now at this point. I don't know if I like the company at the levels that they're at. And again, the market, this company as a whole, is very well affected by current events. And who knows? Who knows what happens? People might be more afraid for public transit again as we go into another fear of cases rising. So I don't know what it looks like, but I'm not. I don't think this reaction was deserved by any means. So if you're a long Uber guy, this is a good time for you to buy in. I'm just not personally, but if this is your company that you really like, I think this is a great entry point for you. And I think it could very well pay off over the next 5 years. But that's what I got for you today, and I hope you enjoyed.